Welcome back. You're still tuned into Trading Hour. Well, Unicommerce, that's the stock on our radar. The company recently announced the acquisition of 43% stake in courier aggregator Shipway Technologies with a plan to acquire a higher stake further down the line. The company also reported earnings which were in line with estimates. To discuss the acquisition second quarter numbers and the outlook for the business going ahead, we have the MD and CEO Kapil Makhija joining in now. Kapil, good morning. Thank you so much for joining in. Well, it's been a good set, and margin expansion is something that was the highlight because you've come in at around 19%, which compares with the levels of around 15 to 17% that you've seen earlier. Is this a trajectory which is maintainable, or maybe you'll improve on it? Because at the time of IPO, the discussions also suggested that SaaS industry as a whole has margins of around 25%. Do you go to those levels?
First of all, thanks for having me here. It's a pleasure being here. I think what we've mentioned before and what we still maintain is that the business that we are in, the core SaaS business that we have, it has a operating leverage, which means that our profits will grow faster than the revenues. A portion of our revenue growth goes to our bottom line. But this is because our costs are largely fixed. Our core platform, which is to do with order management, inventory management, warehouse management, has been built out over many years now. And now incrementally, because we are in a fast evolving industry like e-commerce, there are some incremental investments that need to happen. But other than that, there are no fundamental large investments that are required in our core product. And that's why as our revenue continues to grow, our investments don't need to grow in that proportion. And that's why the business inherently demonstrates an operating leverage. And that's why over the last few quarters, we have demonstrated expanding profitability, and that we want to continue demonstrating to the shareholders as well as the investors.
Okay, so the margin level of 19% is something that is surely going to be sustainable for FY25, FY26 at least, right, Kapil?
Can't really comment on the full year numbers, but we will continue to demonstrate the operating leverage in the business.
Okay, sure. Kapil, I want to talk about the SMB clients because they have largely remained stagnant at 2,600, 2,700 levels, right? And whether you look at it on a quarter-on-quarter basis or on a year-on-year basis that I'm looking at, what is the outlook here, and how are these margins on this front of these clients? Is it something in terms of a better margin versus enterprise clients? How does that work?
Sure. So SMB, the enterprise business, it constitutes nearly 90% of the business. So that's bulk of our business anyway. We view businesses, some large user.
I think we've snapped the line with Kapil, but surely, what he's talking about right now is in terms of margins, which are good because they are seeing revenue growth, which will, in turn, they're not going to be spending much in terms of investments going forward so far. There's limited investments that they're looking at. So margins is something, and profitability, Sonal, is something that they said that, we could see some improvement going forward, and maybe these levels, something that we've seen a sharp improvement over the last few years, that is something that will be sustainable. As of now, the stock is not holding out too much of a gain, but the market has been weak, down almost 1.3% in trade. A decent number is what they managed to report this time, 13% growth, what we saw, margins at 19%. So yes, that's how we are looking at it.
That is about Unicommerce, but if you look at the markets, the mid-cap index. Conversation with Kapil, you were making a comment on the SMB clients and the enterprise clients as well. Please go ahead.
So as I was saying, I hope I'm audible now.
Kapil, can you hear me?
I can. I hope I'm audible now.
Yes, you are. Please go ahead.
I was saying that enterprise businesses constitute nearly 90% of our revenue. And by SMB business, we mean these are businesses that have taken SMB plan. These could be large businesses as well. But typically, the very nature of this businesses that take the SMB plan, there is a higher churn in this business. We view these businesses that take our SMB plan as a funnel to our enterprise business, which constitutes majority of our revenues. So the growth of the business is largely driven by businesses that have taken our enterprise plan.
Okay. All right. Kapil, quickly, if you can tell us, you had highlighted that dropship model is favored more by e-commerce players versus the outright and fulfillment models. What is the split between the two currently? Is there a margin difference as well between the two?
So dropship model, there are three models in e-commerce. There is the outright model, which is a classic first-party model in which platforms are buying inventory from a brand. Then there's a fulfilled by model. The third model is a dropship model. The dropship model is the fastest growing model. It has grown. It is now contributing nearly half of the overall e-commerce volumes. In the dropship model, the brand has the flexibility to control the entire customer experience by fulfilling demand through stock that's lying in their own warehouse or in the warehouse of a third-party player. The Unicommerce solution is most aligned to the dropship model, and this is the fastest growing model. As per our estimates, this model used to be early double digits pre-pandemic, and is now contributing nearly half of the overall e-commerce volumes.
Just Kapil, a quick one in terms of the recent acquisition of Shipway Technologies. If you could just tell us, because the company is, as of now, Shipway Technologies is in a loss. So when do we expect that break-even coming in here and synergies from Shipway for the company?
Sure. So I think over time, whatever financials are there in the public domain, they have showed that the Shipway team has been able to reduce the losses significantly over time. In FY23, as an example, they had nearly 42% of loss as PAT, but in FY24, that had reduced to about 5% of loss. We see a lot of synergy in the business. One, it is very complementary solutions that we have been able to bring on board. Two, there are also synergies on the cross-sell bit. Today, with the combined entity, we now have 6,500 plus brands and sellers which use both Unicommerce and Shipway platform. So we have a large base to be able to cross-sell the products. So through cross-sell synergies, along with synergies on both direct and indirect costs, we are confident that we'll be able to turn around and make the business break even. We can't really comment on the specific timeline, but we are hopeful with these two synergies, we'll be able to turn the business break even soon.
Sure. Okay, Kapil, thank you so much for joining in with us on the show today. But on that note, we're going to slip into a very short break. After the break, we'll talk about why Indian Hotels is buzzing in trade.